Okay, so today's bank is Enterprise Financial Services Corp. They're based in Clayton, Missouri. The ticker is EFSC. They also have some preferred shares, fixed rate 5%, and that ticker is EFSCP, which could be a possibility to buy as well. But yeah, they're based in Missouri, but they've basically got locations all over the U.S. from one side to the other. A lot of the banks that we look at will have sort of a geographic area that they're in, but these guys are just kind of across the country. So good for geographical diversification. So let's see where they are. So we bought this bank about a year ago, and it's basically done nothing since then. So had some ups and downs like we see for most banks, and it's kind of at the middle of its trajectory over the past year. So I'm interested to see what's happened over the past year, whether it's still a good buy. And so let's take a look at some of the preliminary statistics we look at. So it's a $1.5 billion market cap bank, which is a little on the high side of what we normally, or that's in our population for publicly traded bank holding companies. So a little bit on the larger side. PE ratio of 8.4. That's pretty good. It's about a 12% earnings yield. So that's really good for pricing of banks currently, or pretty cheap price on earnings. So it'll be interesting to see, what the earnings are composed of and what the risks are and all that, so we can see whether that is a fair price. So coming over to the statistics tab, we can see a few more things. So the price to book 0.89, and of course that's sort of dependent on whether they have the securities available for sale or held to maturity, because we'll need to convert things to fair value to see what's the price to fair value of net assets. Otherwise, we're not comparing apples to apples when we're looking at the price to book ratio. Anyway, so profit margin's good, pretty high return on assets. That's above the range we normally see, and pretty good return on equity as well. So it looks like it's still got some pretty good earnings. Back when we looked at it a year ago, in order for us to buy it, we would have wanted them to have good earnings and reasonable risks as related to the credit quality, interest repricing risk, and capital liquidity standpoint. So hopefully that's maybe all still the same case, and it looks like they are still pretty profitable. So let's dive in and see what's happening. This will be the quarterly financials for March 31, 2024. Pretty standard balance sheet here. As far as the cash goes, about 375 million or so. That's a little bit on the low end. That's about 2.5% of assets. So we usually see somewhere between like 4 and 6% cash on the balance sheet, so a little bit on the low end. That could be okay. As far as the securities go, we've got some available for sale, we've got some held to maturity, and those two together comes to about 16%, and that's pretty average for most banks. That's as a percentage of assets, it usually comes somewhere between 12 and 18-19% or so. So 16%, pretty average balance of securities. The loans of net of the allowance is almost 11 billion. That comes to about 75%. So 75% is a little bit on the high end of the range we normally see. So I can tell that they're a little bit more allocated toward loans than perhaps the average bank, but not egregiously so. I mean, it's all of this is pretty normal percentages, not far outside the range. So anyway, they do have some goodwill here, which is about 2.5%. That's a little bit higher than normal. Perhaps in the past they've been really acquisitive and built up a lot of goodwill, or from the purchase accounting stuff, recorded a lot of goodwill, and it's as we know, that's kind of a dead asset. It's not yielding anything, right? So whenever we look at the ratios, like tangible types of ratios, we'll normalize, exclude that part. But as it is, pretty normal average balance sheet. So, or at least on the asset side. So maybe we expect pretty normal average interest income. Of course, dependent on the composition of the loans and securities and such. But we'll dig into that in the footnotes soon. Now we've got the liability side. The non-interest bearing deposits, as is always the case, where we want them to have as many non-interest bearing deposits as they can. It looks like they've got a pretty good amount. So this 3.8 billion is about 30% of the liabilities. So that's above the range that we normally see. Most of the time we see somewhere between 20-25%, so being 30%. They've got a big leg up on most banks because they've got lower cost funding there, right? And then they've got a pretty low amount of debt here, and the remaining part is the interest-bearing deposits here. So, it looks like perhaps the interest expense might be pretty favorable for the company because they've just got a higher amount of non-interest bearing deposits, but then also hopefully they're in the lower costing deposits types. So I could see interest expense being pretty low compared to the average bank. So if we've got kind of an average asset side of things and superior liability side of things, then maybe we see a pretty good net interest income. So let's go in and see if that's the case. I'm just going to jump right to it then. So net interest income is 137. Wow, that's 3.77% of assets. So that's a really good yield, net interest income. So we usually see somewhere around 3% for net interest income, but this is at 3.77%. So they're making really good money on the spread between the assets and the liabilities of the balance sheet. So that's awesome. So really good profitability there, and we can see that 207 million of interest income, and that's about 6.10% of the assets, and that's really high. We usually see somewhere around 5%. So them earning 6% of assets on their assets is a really good yield. It'll be interesting to see what types of loans that they're in that allows them to earn that type of yield, and even securities. But of course, the loans are the more material part of the balance sheet. But so as far as the interest expense side goes, so 70 million is about 2.2%. So that's pretty, it's about an average amount. So average for most banks, at least over the past year or so. Here lately, when we started digging into all the 10Qs for the first quarter, they've been being a lot higher than that. So, for this quarter, I feel like that's a pretty cheap interest expense compared to most of the banks that we're seeing. So, that's awesome. They're making really good money there. And if we come down to the non-interest income, we can see 12 million, which is about 6%. As on the low side, we normally see somewhere between 10 and 13% or so. So a little bit less than normal. It'd be nice if they could beef this up a little bit, but this tax credit income perhaps is somewhat volatile. So last year they had a positive amount, and this year they had a negative amount. So if this was more consistent, maybe this would be more in line with the range that we're typically seeing. But as it is, a little bit less non-interest income, but they're perhaps more than making up for it up here in the interest income. So let's see, non-interest expense, 93 million. That's about 43%, and that's right in the middle of the range of what we normally see. So it's a pretty average non-interest expense for a bank right here. So if we come down here, we've got some income taxes, and then we've also got to pay the dividends on the preferred shares. And then so that leaves us about 39.5 million for the common shareholders, and that as a percentage of assets is about 1.08%. So that's a really good, that's right at the top of the range that we normally see. So pretty good net interest income here, mostly because of really good interest income, but then also perhaps a cheaper funding sources that they're using compared to most banks. A little bit less non-interest income, but that's okay. It's more than made up for up here in the net interest income, and about an average non-interest expense. So, really good profitable bank here. Making a little over 1% return on assets. That's fantastic. And if we were to compare these earnings to the market price as it is now, the market cap is $1.5 billion. So, annualizing this, multiplying it by 4, gets us about 10.7% earnings yield, which is also at the top of the range for. So it seems like, not only is the bank making good money, they also it's also at a reasonable price relative to those earnings. It seems like so. But, once we dive into the risks and everything, we'll know a little bit more about is that price really a good price? But if we were just looking at it in a vacuum, it's pretty good average earnings and at a pretty good average price. So I like it so far. Let's dig into the footnotes and see what else we can learn. Yep, so there, it's a bank holding company, and the bank is Enterprise Bank and Trust. You can see they've got locations all over the U.S. I mean, there's not like a specific region that they're in. I mean, so it's basically on all corners, spread out all over the U.S. That's interesting. Getting past the accounting policies here, we can get to the investments. And we see we've got some available for sale and some held to maturity security. Most of the banks that we look at have a lot of mortgage-backed securities, and that's the case for this one as well. But it's only 32% of the securities portfolio. Normally we see somewhere between like 50 and 60% of the securities is mortgage-backed securities. So it's a little bit less mortgage-backed securities and more leaning toward munis, so states and political subdivisions. And that's 42%, about 42%. So we would normally see somewhere between 10 and 20% for this bucket. So they're a lot more allocated toward states, subdivisions, municipalities type of thing. So hopefully they tell us a little bit more about the risk of that, because the mortgage-backed securities, of course, are guaranteed either implicitly or explicitly in most cases with the federal government. So, but in most cases, the municipalities and stuff, the argument will be that they have unlimited taxing authority, and so they not a whole lot of risk, but there are defaults there sometimes. So it'll be interesting to see if they've got some kind of a what they describe the credit risk as and what the credit ratings are for these, if they present them. As it is, about what do we say? About 16% of the assets are securities. So we're not as concerned with the credit risk of these as we are for the loans themselves, because the loans are 75% of the assets. So, but we can see what they have to say. But, until we get to that part, we can look at the term structure in anticipation of our analysis of interest rate risk, and we can see that the 32% of mortgage-backed securities are down here because they don't necessarily have um, identified payment terms, but the other types of securities there seems to be most of them in the later ages. So, but that's what we've been seeing from most all the banks, is that most of the securities are maturing, sometime after 5 or 10 years, and so that's not at all unusual. And hopefully, the term structure of their loan portfolio helps to have some repricing sooner and help on the interest rate risk side as well as the liquidity. But let's see if they say anything about the credit risk. Yeah, for the available for sale securities, they say that all the there's of course unrealized losses on these, as is the case for most all banks right now. As interest rates went up, the value of the securities on their balance sheet went down, and everyone got dinged for it. But they say that the decrease in the fair values of the securities is due to the market interest rates and not to credit quality, so they don't have a reserve on the available for sale securities. Yeah, so it looks like they've done an analysis, they say, and that there's about a $0.4 million allowance on credit losses for its securities. Yeah, it's a really, really small percentage, basically negligible, but maybe in the MD&A they tell us a little bit more about the credit risk there. So getting to the loans, is where we like to spend most of our time, because that's most of the assets, right? So C&I is a big part, as well as commercial and industrial. Commercial real estate. So 43% C&I, and then 43% of commercial real estate. So I can see why perhaps they're earning some pretty good yields on their loans, because they're allocated toward higher yielding loan types. So it'll be interesting to see whether or what the credit risk is related to these, because these not only are the higher yielding loan types, but also the ones with the most credit risk. Maybe not the most, but the highest, and out of the types that they have here. So the ACL here, they've got 135 million. So the allowance for credit losses on loans, 135 million, and that's about 1.23% of loans, and that's on the higher end of what we would see for the average bank. So if the risk within their loan portfolio is average, then an average reserve would be appropriate. But so we can see what's the actual risk in the portfolio once we get down and start looking at the non-accruals, past dues, all that kind of stuff. They've got some charge-offs here. All right, so non-performing loans. Yeah, so they've got 35.5 million of non-accruals, plus 0.1 of 90 days and still accruing, which gets us about 35.5 million non-performing loans, and that's about 0.32%. Yeah, and that's on the low end of the range of what we would normally see for most banks. So perhaps there's pretty good credit quality in here. There's not very much that's non-performing or non-accrual, which is great. Collateral dependent. If we added all these together, it gets us 32.8 million, which is also a low amount. It's only 0.3%, and that's within the normal range that we typically see. Past dues is about 78%, or 78 million. That's a little bit on the high end, but it's within the range of what we normally see. So on average, 0.7%. Yeah. So not too bad. Looks like a lot of it is 30 to 89. Yeah, of course, that's the non-accruals was about this amount. So pretty low non-accruals, non-performing, and then the past dues comes in about average. So not too bad. But over the past quarter, they've modified a lot of loans. 61 million. Yeah, so I feel like that's unusually high. So maybe there is a little bit of trouble in the loan portfolio if we've got a lot that are past due. It's not really a lot. I mean, it's in the range, but it's on the higher end of the range. So we've got some of that that's past due, and they've had to modify a lot of them to restructure them to where the borrower is able to pay it effectively. Be interested to see the classified loans as well. Yeah, so here's the classified ones, either substandard or worse. And so we've got, the C&I, 82 million, commercial real estate, 33 plus 50, so on and so forth. So if we added that up, that gets us about 170, it's about 177 million that is classified. So, that's a pretty high amount. That's 1.6% of the of loans, and it's within the average range that we see, but it's on the higher end. We typically see somewhere between like 1.10, 1.7% of loans being classified, and this company has 1.6%. So average amount of classified loans, but on the higher end. So that in conjunction with the higher modifieds and the higher the past dues were within the range, but still kind of on the high end. So, and then our reserve was average, right? 1.23% of the loans. So if we were to compare those ratios, for instance, the ACL to classified loans, the classified loans being this one, it's about 77%. Most banks have somewhere between 90 to 150% of their classified loans are reserved for. So we're a little bit low there as far as like the reserve possibly not being enough. ACL to past dues is 170%, which is below the range we normally see as well. So somewhere between 200 and 400% is what we'll typically see. But these guys have below that at 170%. So it seems like the ACL to non-performing is within the range, so about 300%. We'll usually see 250 to 450% for that. But so as it is, it seems like possibly they might not have enough of a reserve recorded to mitigate the risks that they have in their loan portfolios, and principally because the reserve as compared to the amount of past dues and and classified loans is not as much as what the typical average bank has. So that's the credit risk standpoint that we make as of now. Perhaps later on there could be some explanations to explain ourselves out of that, but perhaps the credit risk is a little too high. I mean, if we were to to put some numbers on it, the reserve is 135 million, and the classified loans is 175 million. So that's $40 million that perhaps they are under reserved. Just making an estimate here. So $40 million. If we compare that to how much money they've made in the income statement. That's basically all of this quarter's net income, right? So if they were to true up their reserve, they would it would end up being a lot, like a lot, an entire quarter's net income. So that's not cheap. So then I would potentially say that let's say if that happened over a period of 2 years, so that would be 8 quarters. So if they keep the same net income quarter to quarter, that would basically be $5 million a quarter. So $40 million divided by 8 quarters, $5 million per quarter. So if that happened, their net income each quarter would reduce to $35 million. And 35 times 4 to annualize things is 140 million. So that as a percentage of assets of 14.6. It's about a 0.95% return on assets, which isn't too bad. We're normally looking for somewhere between 0.9 and 1.10. So, you could possibly make the argument that if they did end up, they are under reserved for loan losses, and they needed to shore up that reserve, which may or may not be the case, then and if they did it over a period of 2 years, it really wouldn't put a huge dent into their net income to where it put them outside of a normal average return on assets for a bank. So that could be an argument you can make in the case that to make the case that the credit quality is okay. If we compared it to the market price, the earnings yield was 10.7% with these earnings here. So if we took the 140 million that we annualized, as if they had to add or reduce their net income by 5 million every year, and then divided it by the current market cap, which is almost 1.5 billion, that gets us about a 9.5% earnings yield, which is also in the range of what a normal bank is right now. It's at the lower end of the range, but it's within the range. So you might could make the argument that the market price seems reasonable, and as well as the profitability of the bank, if you're willing to take on that risk of the credit quality, that it wouldn't put a major dent in the earnings of the bank enough to put you outside what a normal average bank earns. So just some things to think about, and we can sort of revisit that once we kind of get a full picture of the bank. But as it is, maybe some poor credit quality here, and not enough of a reserve, but that could possibly be okay based on from a materiality standpoint. So let's get down into the next sections. Yep, so they've got about 250 million of cash flow hedges here, plus a $100 million collar, and these are hedging the variable rate loans. So I prefer that the hedges hedge the liability side of the balance sheet rather than the asset side, because especially in this environment, as interest rates are going up, or as the loans that they're originating right now are yielding more than what is currently on the balance sheet. So the more repricing that can happen on the asset side, I feel like the more money they can make in interest income. But it looks like they're trying to hedge, essentially fix the variable rate loans, so they can't take part in interest rates going up. So they know the inside of asset liability management of the bank than I do, but we'll be able to look at more of this once we kind of get down into the interest rate risk part, and looking more at the call report to see what's the repricing timing of the assets and liabilities, looking at them together. So but they also have cash flow hedge on the debt, so this 18 plus 13, which is great. They're basically hedging the subordinated debentures, which are the trust preferred securities, and those are at variable rates. So I think, yeah, so they're hedging those variable rates, and those, for most banks, trust preferred securities, interest yields have gone out the roof lately. So that's good. They're trying to hedge that. It's not a whole lot of money, $32 million based on what was it, $11 billion assets. But anything can help. So moving on down here past the hedges. So fair value measurements. We usually like to see this so we can put the bank in on an apples to apples comparison with other banks that. Some banks allocate more to held to maturity securities, and so those aren't at fair value. And then other banks allocate more to available for sale securities that are at fair value. So there's a difference between comparing the banks like that, but also loans, so which are carried at amortized cost on the balance sheet. So if we compare the fair value, that's 2023 is 2024. If we compare fair value to carrying value, on the asset side, we get a difference of about 350 million, so about 50 million on the securities, and then 300 on the loans. So that reduces equity by about 20%, converting it down to the fair value. And then there's also a few differences in the liability side, but not a whole lot. It's maybe 27 million. Which is only about 1.5% of equity. So making this adjustment reduces equity by about 18%, which isn't that bad. It's less than what we would normally see for most banks. So the balance sheet here is doesn't equal the fair value of the net assets, but it's closer than what most banks are. So anyway, so that puts them at a price to book ratio of about 1.54. So I say price to book, but it's basically price to tangible fair value. So also excluding the goodwill, fair value of the net assets, so assets minus liabilities. Anyway, so 1.54 is pretty cheap. That's below the range that we would normally see for most banks. So, we normally see somewhere between like 1.6 to 2.5 something. So 1.5 times is a pretty good price, and most of the banks that are being acquired lately as well get acquired about at 2 times the net asset value. So it's pretty reasonable price. Also, if we were looking at this from this perspective of capital risk, we could see that the fair value of net assets, tangible fair value net assets, is about 7.5% of fair value of assets. So 7.5% is a really good percentage. It's basically a leverage percentage, So we usually see somewhere between like 5 and 7% there, but in this case it's 7.5%. So they've got a pretty good capital position, I feel like. Yeah. So it seems like a really good price on the net assets, but also they have a pretty good, really good capital position as well. So enough equity in the bank, or at least more than what the average bank has. So carrying on through here, we're down in the MD and A, so we can see if there's any additional information that would be helpful to us. They've put together a lot of the ratios that we've already looked at, so that's helpful to kind of corroborate some of those. Return on average assets, 1.12%, 9.5% return on equity. Those are all really good. Efficiency ratio is 62%. That's basically the non-interest expenses compared to the revenues. 62%. That's pretty average. We most normally would see somewhere between like 60, 67%, something like that. So it's about average efficiency ratio. So that's great. It used to be a whole lot lower, which would be fantastic. Lower is better with the efficiency ratio. So perhaps things have deteriorated a little bit since last year, but as is, that's pretty good profitability there. They've also present some of the percentages that we looked at as well, non-performing to total loans. The ACL is 1.23% of the loans. They don't list the classifieds here or the past dues, but as we remember, the past dues and the classifieds were on the high end. So just looking at this here could be, a little bit not taking into account the full picture. But that's why we dive into these things in detail, make sure we have the information we need to make an appropriate decision. Anyway, now so we can get down to the net interest margins. We can see that interest margin on earning assets 6.2%. That's a lot higher than what we've seen lately, and so that's fantastic. They're making really good money, and we can see that's because of the 6.87% that they're earning on loans. But we also saw that most of those, commercial type loans, and so those come at higher yields, but they also come at a higher cost related to the credit quality, which down the pipe could result in some loan losses or higher reserves. So there is a cost to making more money here, but as it is, they've got a pretty good yield. And then interest-bearing liabilities, 3.22%. If we're comparing that to what happened over the past year, that's a really cheap. It's a really expensive earnings yield, because last year interest rates were a little bit lower. The deposit migration hadn't quite happened just yet. But when you're looking at what we've been seeing for the most recent quarter, that's actually a pretty cheap amount. We've been seeing some 4 to 5% type of thing. So, but this is just on the interest-bearing liabilities. So as we mentioned as well, they have a lot more non-interest-bearing deposits, about 30%. So that would also add into this net interest margin, which is based on total average assets. So it seems that they, perhaps have some lower rates than what the average bank does. Savings accounts is really low. The rest of them are maybe about average for right now. But given that there's 30% non-interest-bearing deposits on the balance sheet, then that boosts up our net interest margin from not only having higher yields on the asset side, but also relatively lower cost funding on the liability side. So making really good money there. It's reiterate 4.13%. Most of the banks we see around 3%, somewhere between 3 and 3.5%. So 4.13% is fantastic. It was a lot more. It looks like last quarter 4.71. That's when the liability side was a whole lot cheaper, 1.72. But still making really good money, which is fantastic. And then non-interest income is down a little bit from last year, but also the linked quarter. And they say here that the tax credit income is usually a lot higher in the fourth quarter of each year, and so we would have to be careful here when we're annualizing income, which is what we typically do for the earnings yields, because the fourth quarter here makes $25 million, actually about $10 million from the tax credit income, but the other quarters are kind of maybe negligible, actually offset each other. So when we're looking at this, should we normalize tax credit income to equal $10 million for the year? Because as it is, what we did was made this be about negative $9 million for non-interest income, and that's a a big flaw in our calculation, because actually for the year it should be about 10 million, not a negative 9 million. So if we did that, how would that alter our assumption? It would give them 10 million plus the negative 9, so it gives them another 19 million of non-interest income. And we talked about earlier that non-interest income was pretty low, but I think that if we give 19 million for the year, that makes it a pretty average non-interest income. So let's work this out then. So we would have assumed 12 million, which is the total here, times 4. So 48 million of non-interest income for the year. And that gave us, like 6% of revenue or something. So if we added 19 million to that, that gives them 67 million for the year of non-interest income. So if we looked at that, so let's just think about it like this. So we had 40 million about 40 million net income. So 40 million times 4 is 160 million. And if we added 19 million to the year's net income from the tax credit income, that'd be 180 million. And 180 million divided by the assets of 14.6, 12.2% earnings yield. And then compared to the market price of almost 1.5 billion, then that gets us 79 divided by 8, about 12% earnings yield. Hold on. Right, so 12% earnings yield, but I think I said the return on assets wrong. So the return on assets would be 179 divided by 1460. 1.22%. Right, yeah, 1.22%. So I guess it's easy math, because the assets, 14,613, is about the same as what the market cap is, 1478. Right, 1480. Yeah, so basically they're going to be about the same. So 1.22% return on assets and 12% earnings yield, and both of those are off the charts high. So if we were to adjust our annualization, like before, we had multiplied this by 4 when we're making those ratios, right, which makes it have like a negative 9 million. But actually, when we're looking in the MD&A, we see that, hey, all the income happens in the fourth quarter, which is about $10 million. So if we consider $10 million as the year, then that should add 19 million to what we had calculated and annualized here. So 20 million minus the 9 million that the 10 million plus 9 million that we had negative here. Anyway, so that's something to consider as well, is that maybe by annualizing this, it makes this bank be a lot more profitable than what we originally thought. And that's actually really nice in comparison to when we were talking about the credit quality, and how if they had to make more of a reserve, it would eat into the profit. But actually, maybe this normalization adjustment sort of evens that out. So those are some things we can think of when we finish our analysis and get the full picture together. But on the non-interest expense side, it looks like it's pretty consistent. It's a lot more than it has been in the prior years. Deposit costs is a whole lot more. So that hurts. But I mean, the non-interest expense is in the average range of the normal bank, so you don't necessarily have much concern there. So now we're down in the securities. Duration's about 5.7 years. It's about normal. It's like they don't really say much about the credit quality, but yeah, loans, we pretty much dug into this pretty deep, so I don't think we need to go through much more. Non-performing assets is a pretty reasonable amount, but it's really the past dues and classified loans that we were principally concerned with. The deposits here, really large percentage of non-interest bearing deposits, which I like. Broker deposits seems to be about a pretty reasonable amount. These would be the ones that we consider as like non-core types of deposits, which are more likely to have flight or be more expensive as well. Yeah, so by looking at the call report, the uninsured deposits are about $4 billion, which is 33%, and that's a pretty average amount. We normally see somewhere between 30-35% as being uninsured, so 33% is not abnormal. We get the core deposits is about $11 billion, so that's about 90% of the deposits. So that's normal as well. We see somewhere between like 87-92% in most cases. So and that's basically a function of how much broker deposits they have, and also time deposits that are larger than $250,000. But anyway, so I feel like the deposits are in a pretty good position where most of them are core and seem to be where they'll be sticky, and that's a great quality. And as far as the liquidity goes, as we mentioned, they've got a little bit less cash than what most banks do, and about an average amount of securities. So maybe their liquidity is okay. We looked at the call report, and we can pull how many of their securities have been pledged, how many of their loans have been pledged, and also compare that to what the financial statements say about how much they have left to that they could, or how much has been collateralized that they could borrow additionally from the Federal Reserve or the FHLB. And we can see that they've got $2.5 billion that they could borrow from the Federal Reserve, $1.3 billion that could borrow from the FHLB, and then they've got some Fed funds lines like $120 million, and a line of credit at the holding company for $25 million. So basically, when we're just looking at the on-balance sheet liquidity, so that would be the cash plus unencumbered securities. They've got $370 million of cash, and then about half of their securities are pledged. So it's about so that gives them about $1 billion of securities that are unencumbered. So that's about $1.4 billion of on-balance sheet liquidity, which is about almost 12%. So almost 12% of deposits. So that's on the lower end. We usually see somewhere between 13 and 18%. So from a on-balance sheet liquidity perspective, maybe they're a little bit on the lower end. But whenever you take into account that, hey, they can borrow this $2.5 billion, they can borrow this $1.3 billion, that puts them at about 83% of deposits. So once you add all those things together, cash and unencumbered securities and the potential borrowings that they could borrowing capacity that they have here, that's about 83% of deposits, which is above what we normally see. Typically see like 70 to 80%. So they might not have the on-balance sheet liquidity, but they do have enough pledged at wholesale funding sources where they can borrow money if they need to, which is of course a higher cost of capital, but they would have enough to fund their operations and potentially anything else they need. So I feel pretty good about the liquidity. As far as looking at the capital itself, which I usually think about it like the equity of the bank, and so we saw that converting the equity to fair value gets us a really good ratio of assets. So I feel like they're really well capitalized. If we look at the regulatory ratios here, leverage ratio, common equity tier 1, total tier 1. These end up being pretty average range as well. So it's a little bit more evidence to say that they're pretty well capitalized, and especially because they've got a lot of commercial loans, so which kind of get dinged in the risk adjustments, right? So yeah, and if you look at the more traditional ratios as well, common equity ratios over 11%, which is high. We typically see somewhere between 9 and 10.5% for common equity. Even the tangible common equity ratio is 9%, and that's high. We normally see 7.5 to 8.5%, something like that. So they've got a good amount of tangible common equity, and so I feel pretty good about the capital. And in conjunction with the ability to borrow a lot from the wholesale sources, then I feel like they could really weather anything that were to happen. So really good capital, and yeah, so they're talking about some of these ratios that we've calculated as well. Yeah, really good capital position. As far as interest rate risk goes, just looking at this chart, we can see it's perhaps asset sensitive, which is my preference for where the market is currently. As we talked about, some of the securities are maturing later, later than 5 years, which is typically the case for most banks, and so that's not that unusual. And then, as far as the deposits go, they have 30% of their deposits as non-interest bearing. So that means 30% of them don't reprice to anything, right? And, hopefully they don't migrate to interest bearing accounts, and that could very well be the case soon. But they don't have a whole lot of debt either, which would kind of push some of the repricing out further. So most of it, or 57% of interest bearing, 57% of it is of the liabilities is interest bearing. 57% of the deposits is interest bearing, which is, sorry, if we look at the savings accounts and all that stuff and add time deposits that reprice within the next year, that gets about 67% of the deposits, which is a pretty low amount. We normally see somewhere between like 65 to 75% in that bucket. So the non-interest bearing deposits are helping the interest rate risk here. But what's really helping is the loans. So 56% of the loans reprice within the next year, and normally we see something like 25 to 35%. So 56% is almost double, and so that means there's a whole lot of loans that reprice soon, and that's really helping it to be asset sensitive. Where when they reprice, those loans reprice, they reprice at the newer rates. And hopefully those newer rates are higher than what is on the balance sheet currently, and I think that's the case. And so within the next year at least, they reprice faster than what the deposits and debts do. So that should expand our net interest income. Anyway, so there's a lot of projections and other factors that will go into that, but at a crude estimate, that's what we're looking at, which is fantastic. And so this is the end here. So we can maybe summarize a lot of things that we talked about. We did a few complex, not complex, but calculations that require a lot of explanations. That makes it harder. But from a profitability standpoint, the bank currently makes good money, and that's even that good money is at a reasonable stock price as well. And we also noted that we should perhaps adjust this quarter's income to put the tax credit income at a more annual annualized appropriate rate, which even boosts their net income further, and even makes the valuation a whole lot cheaper. So as the earnings by themselves is awesome. Getting into the risks, we saw that the credit risk is potentially a problem, and comparing the ACL, the allowance for credit losses, to classified loans, we could estimate about maybe how much of an additional reserve should they accrue for that, and by doing so, it of course eats into the net income of the bank, but when it does that, it doesn't reduce the net income to a level to where the bank is outside of a normal range as far as profitability or even value. So it almost makes me think that, yeah, there is that risk there, but from a material financial ramification from that, it doesn't hurt us that much. And of course, we're making an estimate. It could go down the road, and the bank would just get tarnished with its loan losses. But the way it looks now, we could still be making pretty good money, even if we needed to increase the reserve and there were some loan losses to put it in line with the classified loans. So I would not deter from the potential to buy the bank just because of that, right? I feel like perhaps the bank's priced appropriately to compensate us for that risk that we're taking, and we won't take that much of a hit if it were to happen. So the other two risks are the interest rate risk, which we saw, interest rate risk and the capital risk. So interest rate risk, we saw that they have really good interest rate. They're very asset sensitive, it seems, and that's where the way I like them to lean, and at least in this environment. And that's because a lot of the loans reprice quickly, and they have a pretty low amount of non-interest bearing deposits, which don't reprice, right? And yeah, so really great interest rate risk. And then from a capital risk standpoint, we saw that they've got pretty good off balance sheet liquidity that they could use if they need to, and the equity capital ratios are really good compared to most banks. Even converting everything to fair value, they're at a really well capitalized position. And it could be the case that since there is a lot of commercial loans, that they're being a little conservative there, which is fantastic. So anyway, all that to say, I feel like it's the price that the bank is at is appropriate. By making the adjustments we did and the analysis we did, we saw that the bank is perhaps yielding 12% on its market price, which is a really good yield, and making 1.22% return on assets. That's by adjusting and normalizing this quarter's earnings to what we expect. So that might not come to fruition, but by having the earnings yield be above average, that gives us a little bit of a buffer to if the credit quality does go a little bit awry, right, or the normalization of our earnings was not perfect, and so that gives us a little bit of buffer to where if there is a decrease in the net income than what we expected, then we still end up being within the range of a normal average bank, and would have made a good buy decision. So anyway, I would say pretty good bank at a pretty good price, and the risks that they have, principally the credit quality risk, is manageable. So anyway, that is it. Let me know if there's any additional thoughts you have. I'd love to hear what you think about it and whether, why my way of thinking is appropriate, and whether I missed anything, let me know. So thank you very much for listening.